Hello Sector Watchers, welcome to the show. This is the 111th episode of Sector Spotlight for Tuesday the 18th of January, recording it on Monday prior. My name is Julius de Kempenaer and I'll be hosting the show as usual, presenting from Amsterdam in the Netherlands. If you want to stay in touch, please use any of the handles in the screen. You should know the drill by now. What are we going to do, or what's the plan for today? We're going to do, of course, an overlook of rotations that happened in asset classes and sectors last week. Look at the weekly picture, put it in a little bit longer term perspective. And then for this week, I would like to shift the attention to the equal weight sectors. So do a similar exercise, but then looking at the equal weight, see if we can find any differences or similarities. And then when we've done the equal weights, put those on the sector rotation model as we do that from time to time here in Sector Spotlight. And when I asked for suggestions for segments in the show in my last Chart Watchers article of last year, or the first of the new year, and depends a little bit on how you want to look at it. A few people mentioned actually that they like the sector rotation model and would like to see more frequent updates. The last one we did was at the start of December. We're now solidly halfway through January, so I thought it would be a good time to see how things are going on in that area, put the model on, look at the rotations and see what we can find. So without further ado, let's get started, and this is Sector Spotlight. When we kick off with asset classes and look at the rotations over the last 5 days, so that's ending Friday, we see a very good week for commodities, up 2.7 and 3.8. The benchmark itself, so VBINX, the Vanguard Balanced Index Fund, was down 40 basis points. And above that we find, and that's interesting, both government bond and SPY on top of it. And you can see that there's actually an underperformance for corporate bonds, and they're also present inside that balanced index fund, and it's all very close together. Especially stocks at minus 0.3, so the S&P down 0.3, Vanguard down 0.4, and corporate bonds down 0.4, and that's enough to put SPY just above. That's only a little notch. And then we have government bonds down 0.2, which is quite a bit of outperformance given the low numbers over the week. So that's an interesting rotation that we're going to look at later on. We see the US dollar losing some of its strength, down 60 basis points, the dollar index. And then real estate had a very bad week with a loss of 1.4%. If you look at the tails, then we see that represented with SPY moving from leading into weakening. The same goes for real estate, for VNQ. We have both commodity indexes inside the leading quadrant and actually picking up a little bit of momentum again. And we've got all the fixed income stuff, high yield, government bonds and corporate bonds, all at strong headings, inside improving and high yield actually already moving into the leading quadrant. And we see still some strength for the US dollar there, despite the fact that it is down 60 basis points. That's looking at the trends. If we compare this to the weekly version of this chart, then we see that strength of commodities reflected in that strong rotation on the tails, which are both tails are curling back up towards the leading quadrant while they are inside weakening. You see the rotation of SPY stocks inside the leading quadrant rolling over. That's now probably getting accelerated by the weakness of SPY here. You see VNQ still as a strong asset class on the longer term perspective, but the short week to week segment here on the tail is the result of that, that move down here. You see the US dollar still strengthening. We're going to have a look at the movements on the charts later on, because I'm not entirely sure whether that's going to live very long. And then we see the cluster of corporate bond asset classes all continuing their improvement. Now there's a few individual stocks that I want to share with you. And the first one is interesting because that's VBINX. That's the benchmark itself. And we don't look at that chart very often. But when I was browsing through the charts preparing for the show, I have this in my set of charts, and then I noticed that we're actually breaking out of a trend channel, and we're actually, last week, we've completed a double top. And that's interesting because it sort of puts an end to that uptrend that we saw, much longer, but especially the one that I was monitoring from early 2020 onwards. Also confirmed by the negative divergence between price and RSI. So all in all, not too good of an outlook for both stocks and bonds on the longer term picture. This is something I want to keep an eye on, because this means that, actually it means that if this continues, that both stocks and bonds could be going down, pulling that asset class, that balanced index fund down, and that would be a first time for a very long time. Now quickly look at the US dollar. Here you see the strength still reflected in the RRG. That's the improvement in the route strength. But on the price chart, you see that the dollar index actually dropped back to its breakout level. So here for the dollar index, it's actually not too bad. We're still inside that channel, so this could be a good buying opportunity for the dollar index. If I look at the dollar versus the euro, so euro dollar, this is also breaking out to the upside, and it is a reverse. So we would like to see it breaking to the downside for dollar strength. So this actually means euro strength. Now there's a few levels on top. So we have some resistance coming in here around 115. If we stay below that 115 area, then the trend of dollar strength could continue, but it is definitely a warning signal that I'm keeping attention on. I'm paying attention to. And let's make a very quick move to the RRG for currencies against the US dollar, because that probably tells the story of what's going on here. And here you see the RRG for the G10 currencies, or G9 versus the US dollar. The dollar is the 10th in the G10. And what you see is that everything is still on the left. That means that the dollar is still very strong. And we see a few, in the lagging quadrant, we see a few tails that are definitely all strongly heading lower. So this is euro dollar. Let's forget about that one for a minute. So all these red tails are pushing further down into the lagging quadrant, pointing to dollar strength versus all these currencies. Now the US dollar actually is on a move. So we see euro strength versus the US dollar, and that's what we see in this graph. So the euro is strengthening versus the dollar. And then we have a few, so we've got the yen strengthening, and we've got the British pound strengthening, and the Swiss franc is already rolling over. So out of this whole G10, basically the euro, the yen, and the pound are currently strengthening versus the US dollar. So versus the whole basket, which is that reflected in that dollar index, that is still pointing to dollar strength, but there's a few pockets of currencies that are picking up versus the US dollar, and that's yen, pound, euro. And Swissy is already rolling over. So we've got to keep an eye on it. They're still on the left-hand side, so they're still weaker than the dollar over that whole period. But very recently, they started to improve. So the big question is, and let's focus on the euro, whether the euro is strong enough to pull that whole thing back into the leading quadrant. Given the position, because it's the second weakest when we measure on the RS ratio scale, I would be very surprised if the euro would be able to be sort of a lone ranger and detach itself from that whole cluster of currencies that is weakening versus the US dollar, so dollar strength. I hope it makes sense. All in all, I think that what we now see is at least a short-term strengthening for the euro, the pound, and the yen. Questionable whether that is going to be sustainable for a longer-term move. But keep an eye on it, especially the euro-dollar chart, because that has now at least put a pause on that downtrend there. We quickly move to SPY. Then we see that the relative trend versus VBINX is still there. It's losing a bit of momentum, and that's what you saw on the RRG here as well. We see that the trend in price is still there. It's just going at a slightly slower pace. And that's better visualized when we look at the weekly chart of the S&P. You can see that that rhythm of higher highs and higher lows is still there. The weakness of the last 2 weeks is very visible, but we are still above that lower boundary of that rising channel. So far, so good. What is still a potential pressure and a potential source of downward movement is the negative divergence that's back in play between the RSI and the MACD. So there is a battle going on now. You see that the overall move in the S&P over the last 2, maybe even 3 months is sort of sideways. And we definitely need some sort of a signal, a catalyst in the coming weeks to get a new direction. And where that will be, I have no idea. We just have to monitor the chart and see where it's going. I'm not very happy with the breakdown in VBINX, especially not when you look at government bonds that are now confirming their breakout that we saw last week. You see that corporate bonds are now breaking out of an already falling channel. That's usually not a very good sign. And we have high yield, which is now really pushing against its lower boundary with a few lower peaks in place as well. So from an asset class point of view, the dominance of stocks is fading, or at least coming to a pause. There's a little bit of strength from a relative perspective on the fixed income side, but the overall benchmark, the VBINX, is sending negative signals. So that whole thing could at least come to a pause in the next coming week. So I believe that we are in a quite crucial period where we have to monitor the big picture on the balanced index, both stocks and bonds, but also don't forget about high yield and corporate bonds. The only stuff that is no doubt is very strong are the commodities, DJP and GSG. When we switch over to the equity side of things and look at the rotations of sectors, then we see on the daily chart very nice tails for energy and financials. And especially energy pops up at the top of the range with a gain of 5.2%. Financials lost 80 bips and is actually underperforming the S&P 500. But the trend, because remind you that the RRGs look at the trends versus the S&P. So it's definitely possible, and this is a good example, that a tail shows up in the leading quadrant, but over a shorter period of time, in this case 5 days, the sector is underperforming the index. But we look at the trend, and the trend is more important than the day-to-day noise. You see that energy and financials is actually showing very strong moves on the daily time frame. On the weaker side, we have real estate and also discretionary with a loss of 1.5%. And that is here inside the improving quadrant, and it's actually rolling over back down to lagging. And that's a negative sign for the discretionary sector. Industrials moving inside leading, that's pretty strong. We see materials inside leading, but rolling over with very short tail, so that's holding up there. And we see staples actually moving back into the leading quadrant and the tail shortening, which means that it's a stable trend. If you look at the longer term, so here's the weekly RRG, then we still have that story standing and it hasn't changed that especially the defensive sectors are doing really, really well. And these defensive sectors are staples, which is moving very strong there. And if we look at the daily rotation, then you see staples here. So that is a good match. You see utilities actually at a very nice heading, moving towards the leading quadrant. And if we look at the daily, then we see that utilities are still inside weakening, but they have started to move up, moved a little bit to the left. See if I can blow that up, that yellow against orange. So we need to see utilities actually pick up and rotate back up. The longer term move here on the weekly is still pointing pretty strongly at the leading quadrant. And then there's the healthcare sector, which is, well, I mean, sending confusing signals over the last 2-3 weeks, I have to say. Because if you look at that daily, then you see, if we go back here, it started to roll over. This is end of December. It stopped actually outperforming and dropped, and now moving into the weakening and then into the lagging quadrant. And that's actually shortening the segments on this weekly tail. So of these three defensives, healthcare is the weakest, but definitely still at a good heading together with utilities and staples. And that is still something that I've got in the back of my mind as a warning signal. When these defensive sectors are doing well and outperforming the S&P 500, at least it's a warning signal. At least it's a warning signal. If you look at the rotation, communication services is still the weakest. Inside lagging is picking up a little bit of momentum, but way too far down on the RS ratio scale to be anything meaningful. We have the consumer discretionary actually confirming its weakness that we saw on the daily, now rapidly heading into weakening. That's a dangerous sector at the moment, I believe. Technology is kind of holding up. It's a short tail, but we're going to look at the chart in a minute. We should not drop too much further right now with technology, because it could come very weak, very nasty, very quickly. Let me put it like that. If we look at a few individual charts, let's start with that technology sector. Then you see that uptrend, the uptrend's still there. We're still above that rising trend line. But over the last 2-3 months, we've got this whole, wood of bars with only marginally higher highs. But there's a big, fat block here where technology is trading. I guess as long as we're trading above 160, everything is sort of okay from a price perspective. If you look at the relative strength, we had that breakout. That was a good moment for technology, but it didn't get a real good follow through. We're now resting on top of that old resistance, now support. That should hold. If that holds and price starts to move back up, then technology could come back into the game. If we drop back below support on the relative, as well as drop out of this rising trend channel, technology is very likely in a little bit more trouble. If we look at discretionary, it's slightly similar, a little bit more pronounced here. This could become a double top pattern, especially when we break below 190 on XLY. And we see that on the relative, we're already bounced off that upper boundary of that range. So I suggest be very careful with discretionary. The problem is tech and discretionary are about 40% of the S&P 500. So if those two start coming down, it'll be very difficult for the S&P to hold up. One sector where we saw the hookup here in financials, that's interesting. We see that is strengthening, is breaking to new highs. That is a good thing, so keep an eye on financials. Energy is really, really strong, and we're now pushing against a major overhead resistance level. That's about 7 years old resistance that we've touched 1, 2, 3, 4, 5 times, and we're testing it right now. If we go below 65 in XLE, that'll definitely pull the energy relative strength back up. That could be a signal for a much longer move of outperformance for the energy sector, and the rotation on the RRG is absolutely clear already. If we look at staples, one of the defensive sectors, we see that relative strength has broken out. We're pushing against the upper boundary of that trend line, of that channel. That trend is still intact, and I expect more outperformance for staples going forward. And then we have utilities also pushing against a major overhead resistance level. We tried it a few weeks ago, dropped back. It looks as if we're going to try again, and that area is around 71, let's say between 71 and 72. Above 72 would definitely be a very strong sign for the utility sector. For starters, I want to take you back to the situation as we've judged it at the start of December. So this is the model that I presented at the start of December. And what you can see is that we had that that cluster of defensive sectors already outperforming. A few in orange, kind of, like on the edge, and a few reds. Now, I want to take a look. I want to combine the equal weight sectors and the sector rotation model because of time, and also because I think that the equal weights are probably better suited to make a judgment call for the preference of sectors inside the sector rotation model. When we look at the rotation for the equal weight sectors, they're on the left-hand side, and I've got the spider sectors as a reference on the right-hand side. There's a few tails that are definitely different. And the most important one is the industrial sector. If you look at industrials, it's already inside lagging, rolling over. And if we look at industrials in the spiders, it's in improving and heading towards leading. So under the hood, without the large caps, or the mega caps, the industrials are already rolling over. A similar thing is happening with discretionary. Consumer discretionary in the equal weights already inside lagging and increasing the length of the segments downward. And if you look at the cap weighted, it's inside weakening, but still far to the right. And even if you would look at technology, then you could say that there is a difference there, because here it's much closer to the benchmark, much closer to crossing over. The rest of the sectors are pretty much showing you similar rotations. And for me, that gives you the situation as I will show you on the actual update of the sector rotation model. Before we go there, I want to go quickly over the 4 macroeconomic indicators that are essential for understanding the sector rotation model. And here are the 4 charts. So here is the consumer sentiment. That is now, I think that is definitely declining. That means full recovery. If you look at the industrial production index, that is rising. You could argue flat because it's not rising very rapidly anymore. So rising to flat, that's early recovery to full recovery. If you look at interest rates, I think they now started to rise rapidly, which means that market is or the economy is in a full recovery, bottoming out. So it's definitely somewhere here, but it's leaning towards a full recovery phase. And if you look at the yield curve, that is now flattening. It's normal, but it's flattening out. That would be full recovery or early recovery. And if we bring that to the sector rotation model, then the image has changed quite a bit. I think we can safely say that we are not in the early recovery big bull market phase anymore. Even if you could actually argue that technology could be red because it's already rolling over. That would be a very aggressive call. So I made it orange. But materials, energy, staples, utilities, real estate, financials, they're all on the right-hand side and moving to the top right. And healthcare is getting there, so I made it blue. Compared to the previous situation, you can see that everything has sort of shifted to the right. The greens have shifted to the right. Everything to the right is now more green and is outperforming. So we're either in this market top or already over it. The problem is that it's not really clear. If you look at the chart of the S&P 500, we're still in that uptrend. So that makes it a little bit difficult, and it's not a science-based thing, this sector rotation model. But I think that the most important message that we get from this sector rotation model right now is that we are definitely not at the start of a beginning bull market anymore. We are closer to a market top and in a full recovery of the economy, moving over into a bear market. If that's going to happen next week or next month, I don't know. But I would urge at least some caution under the hood that could threaten the current uptrend in the S&P 500 and the stock market. And that wraps up Sector Spotlight for this week. I hope you enjoyed the show. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Please share your thoughts and ideas and comments as usual. And for sure, I hope to see you again next week, same time, same place, at a new episode of Sector Spotlight.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.